We've seen a much more positive start to equities this week. Clearly, if we look at the FTSE 100, it dropped very sharply on the back of the Japanese earthquake, and we saw the FTSE temporarily touch 5,600. But since then, we're fast approaching 6,000 again, a very, very sharp recovery in equity prices, and I think it's probably felt more acutely over in the Dow Jones, the US market. I think it's been observed that the US markets have actually proved to be far more resilient, and as we can see from this chart here of the Dow Jones, that we're not far indeed from a high. I think looking forward, one point that I think could drive equity prices higher again over the course of the next 2 or 3 weeks is that many US companies are reporting their first quarter earnings. This will begin to start in early April. But the feedback that certainly we have been seeing is that corporate earnings are coming through more positively, particularly for the big industrial companies and particularly those big American companies in the technology space. And so if we start to see some very good first quarter reports, I think that will become the overriding sentiment of these markets. So it does appear to have at least absorbed some of these very large market shocks. However, we mustn't lose sight of the fact that there are some very sort of critical things going on within the EU at the moment. We saw this week that the austerity drive within Portugal was voted down. We have seen a resignation at Parliament there. So the EU issues are not going away, but as I say at the moment, I think largely containable, and equity markets beginning to focus back on corporate earnings. So just keep an eye over the next couple of weeks on corporate earnings. Back here in the UK, the news on corporate earnings has been more mixed, and certainly on the retail side, which we've been talking about over the last couple of weeks, we're starting to see the results coming through from a number of our retailers. Interestingly, the performance of the shares has been sort of different in various companies. We would start off with Sainsbury. The food retailer is one of the first retailers to report results of all of the majors, and I think Sainsbury is generally regarded as a company that are taking market share off of some of the other majors like Tesco and Morrison. That's still yet to be confirmed, but the results from Sainsbury did disappoint, and we can see here a very sharp price drop in the shares of Sainsbury during the course of this week. So maybe expectations were too high going into it. One of the critical numbers that you tend to look at is the like-for-like number. This takes into account all of the new space that's been opened by retailers and says, look, for every square foot of space, how much more sales have we achieved during the course of this year? And I think Sainsbury's number, when you strip out the fuel costs, was up just 1%, whereas market forecasts were for over 2%. So we're certainly seeing very much slowing consumer spending as being one of the driving factors for Sainsbury shares. As I say, the price drop there came and did hit the sector. Stocks like Tesco also dropped temporarily. But actually another company in the retail space whose share price actually performed very well was Next. Possibly that going into these results the negative view was probably too negative. Next by no means are saying that things are rosy on the high street, but what they are saying is that they expect to hit their profit targets, and as we can see there has been a very sharp reversal of fortune. So quite pleasingly, we did point out a couple of weeks ago the very much underperformance of the retail sector in the UK for share price terms, and that maybe a sector to hunt around in. Some of the quality names there are coming through. Much more on the international scene. I think that moving to currencies, the currency to watch over the course of the next few weeks and months is the Japanese yen. The Japanese yen has been an extremely strong currency over the course of the last 2 to 3 years, and as you can see there, it temporarily spiked up against the US dollar to this point, and that was a level where the G7 community said enough is enough. They stepped into the currency markets in effect to sell yen and to drive the yen down to a level, and I think that may well have drawn a line in the sand. Clearly a very strong currency becomes very critical to a country like Japan that is a big exporting nation, particularly as money is being repatriated back to Japan to assist them in the recovery after the earthquake. Then clearly a very expensive currency currency makes that process even more expensive. Now, I think the fact that G7 appear to have drawn a line in the sand, for me, is very indicative of what may create a bit of a reversal in Japanese yen sort of strength over the course of the next few weeks. So that's something I'm watching. Just coming back to the budget, briefly to comment on the budget, we had a sort of a business-friendly budget, certainly in corporate tax, and a few little pleasant surprises in there in the pace of change of corporate tax. That has helped some of the more domestic companies, which feature more in the FTSE 250 and FTSE 100. Two sectors to highlight here. One would be the oil sector. This is a smaller company called Encore Oil, but I just want to observe how that stock was hit by the budget. We heard that taxation on oil stocks operating in the North Sea was going to go up quite markedly, and so Encore shares were hit. But a sector that benefited from the budget was the house building sector. Now, news on the house building front is certainly not looking particularly promising at the moment, and particularly in the US, housing is still very, very slow. But trying to cut through some of the planning bureaucracy is helping some of the new house builders. Our prime choice in this sector is Bovis Homes, and we can just see there that we've seen a bit of a sharp breakout on Bovis Homes. So maybe the house builders have got another leg to the upside in them.